The dollar makes no sense. It's just paper, or more accurately, numbers on a screen. And yet that paper runs the world. Countries trade oil with it. Central banks hoard it. Governments borrow trillions in it. If the dollar sneezes, the global economy catches a cold. But lately, a group of countries has been quietly asking a dangerous question. What if we just stop using it? Welcome to the Great De-Dollarization. BRICS versus the USD. How the dollar took over the planet. After World War II, the global financial system was redesigned at the Bretton Woods Conference. The idea was simple: anchor the world economy to something stable. The US dollar was pegged to gold at $35 per ounce, and other currencies were pegged to the dollar. Gold-backed money, stability, order. Then in 1971, President Richard Nixon ended the gold standard. The dollar became fiat currency, money backed by trust instead of gold. Today, the US dollar makes up about 58% of global foreign exchange reserves. That's roughly $7 trillion sitting inside central banks around the world. In dollars, around 88% of global foreign exchange transactions involve the dollar. Oil, mostly priced in dollars. International trade, largely settled in dollars. The world runs on green paper and digital entries controlled largely by one country. Now imagine you're not that country. Enter BRICS. BRICS originally stood for Brazil, Russia, India, China, and South Africa. But in 2024, the bloc expanded to include countries like Saudi Arabia, Iran, Egypt, Ethiopia, and the UAE. That's not a small club anymore. BRICS nations now represent nearly half the world's population and around 30% of global GDP in nominal terms, and even more when measured by purchasing power parity. China alone has a GDP of about $18 trillion. India is above $3.5 trillion. Combined, the expanded BRICS economic weight rivals the G7 in PPP terms. That's serious leverage. And they're asking, why are we still using dollars for everything? Why the dollar gives the US so much power? When global trade is settled in dollars, countries need dollars. To get dollars, they export to the US, borrow from dollar markets, or hold dollar reserves. This gives the United States enormous financial influence. For example, the US can impose sanctions and effectively cut countries off from the dollar-based system. When Russia invaded Ukraine, Western nations froze roughly $300 billion of Russia's central bank reserves. Just like that. If your reserves can be frozen, are they really yours? That moment made many governments rethink their exposure. Global foreign exchange reserves total around $12 trillion. About $7 trillion of that is held in dollars. The euro accounts for roughly 20%. The Chinese yuan holds about 3%. The rest is spread across yen, pounds, and others. Now imagine just 10% of that $7 trillion shifts away from the dollar. That's $700 billion moving elsewhere. That's roughly the size of Switzerland's entire economy. Even a 5% shift represents hundreds of billions of dollars reallocated. And some of that shift is already happening. The dollar's share of global reserves has declined from over 70% in the early 2000s to around 58% today. Not a collapse, but definitely a trend. China's push for the yuan. China has been actively promoting the international use of its currency, the yuan, also known as the renminbi. Beijing has signed bilateral currency swap agreements worth hundreds of billions of dollars with dozens of countries. These agreements allow trade to be settled directly in local currencies, instead of converting everything into dollars first. China and Brazil agreed to settle trade in yuan. China and Saudi Arabia have discussed pricing some oil sales in yuan. If oil, the backbone of global trade, begins shifting even partially away from dollars, that's symbolically huge. For decades, oil has been tied to the petrodollar system. Oil exporting nations price oil in US dollars and often recycle those dollars into US Treasury bonds. The US national debt is now over $34 trillion. Foreign countries hold roughly $7 trillion of that debt. Japan and China each hold more than $1 trillion in US treasuries, although China has gradually reduced its holdings over recent years. If major economies reduce their dollar reserves, demand for US bonds could decline. Lower demand can mean higher interest rates. Higher rates make it more expensive for the US government to borrow money. This isn't happening overnight, but it's a strategic pressure point. Gold, backup systems, and financial insurance. BRICS nations have also discussed creating a new trade settlement currency backed by a basket of commodities like gold or oil. Russia and China have significantly increased their gold reserves. In 2022 alone, central banks worldwide purchased over 1,000 tons of gold, the highest level in decades. China officially holds over 2,000 tons of gold, and many analysts believe the true number may be higher. Gold has one advantage: it can't be sanctioned. It can't be frozen by another government. Then there's payment infrastructure. The global banking system relies heavily on SWIFT, the messaging network that allows banks to communicate and transfer funds internationally. When Russia was partially removed from SWIFT, it disrupted its global financial access. So alternatives are being built. Russia created SPFS. China developed CIPS. They're smaller and less dominant, but they exist. It's like installing backup generators in case someone cuts the power. Why the dollar still dominates? Here's the reality. The dollar isn't dominant simply because the US says so. It's dominant because markets trust it. The United States has the deepest and most liquid financial markets in the world. There are trillions of dollars in highly tradable, relatively safe assets. Capital moves freely. Investors can enter and exit markets without extreme restrictions. That level of openness matters. China's financial system is more controlled. The yuan is not fully convertible. Capital controls limit how money moves in and out. For a currency to become the world's primary reserve, global investors need complete confidence they can access their funds anytime. Trust is infrastructure, and infrastructure takes decades to build. The slow shift in trade. BRICS countries trade trillions of dollars among themselves every year. If they gradually settle more of that trade in local currencies, dollar demand naturally decreases. For example, if India buys Russian oil using rupees instead of dollars, that's one less dollar transaction in global circulation. If Brazil pays China in yuan, that reduces reliance on the US financial system. BRICS countries collectively account for more than $5 trillion in annual trade. If even 20% of that shifts into non-dollar settlements, that represents about $1 trillion redirected away from dollar-based flows. Again, not a collapse scenario, but a structural shift. Small percentages, massive absolute numbers. What happens in a crisis? Interestingly, during global crises, demand for dollars often increases in 2008. And again, in 2020 during the COVID-19 shock, investors rushed toward US Treasury bonds. The US Federal Reserve opened emergency dollar swap lines with other central banks because global demand for dollars surged. In moments of panic, the dollar is still seen as a safe haven. That's a psychological advantage that's incredibly hard to replicate. A multipolar financial world, the most realistic outcome isn't the sudden death of the dollar, it's diversification. Central banks are slowly increasing gold reserves. Countries are signing more bilateral currency agreements. Alternative payment systems are emerging. The dollar's share of reserves is declining gradually. Instead of one dominant currency, we may see a multipolar system. The dollar remains powerful, but shares space with the euro, the yuan, and possibly a BRICS settlement unit. The global reserve system might move from 70% dominance to 50%, then maybe lower over decades. Not a revolution, an evolution. The real question: the Great De-Dollarization isn't about eliminating the dollar tomorrow, it's about reducing dependency. If you're a rising economic power, relying entirely on a financial system controlled elsewhere introduces risk. Diversifying trade currencies, holding more gold, and building parallel infrastructure is simply strategic hedging. Right now, the dollar still holds roughly $7 trillion in global reserves. It still dominates oil pricing. It still anchors international finance. But even a 5 to 10% structural shift represents hundreds of billions, potentially trillions, of dollars changing direction. And when you're operating at the scale of $12 trillion in global reserves and $34 trillion in US debt, even small changes ripple through the entire system. Money isn't just paper. It's trust, leverage, and power measured in trillions. The question isn't whether the dollar disappears. The question is whether one currency can remain at the center of a world that's becoming increasingly multipolar. And that shift? It's already underway.